Hello, and welcome back to Hint Hive. Today, we're going to be looking at the economy. We're going to be looking at something that affects you. We're going to be looking at the Fed interest rate hike. So make sure you watch till the end. And if you're new to this channel, don't forget to like, share, and subscribe for more videos. So this video is going to be talking about the Fed rate hike, what it is, how it affects your budget, how it affects your mortgage, and how it affects the stock market. For this video to make sense to you, you need to start from the beginning, which is knowing who the Federal Reserve Board of Governors are. The Federal Reserve Board of Governors is the governing body who sets the rate at which banks can lend to one another. The Fed rate hike, to put it in simple terms, is the rise in the federal funds rate. This is used to set short-term interest rates for borrowing money. And when this usually happens, it's because the economy has grown enough or inflation has grown enough for them to take action. Next, you might be wondering, how do interest rates affect my budget? Interest rates are a key factor in any budget. They not only affect the monthly payments for your loans and mortgages, they also affect how much you save over time. So when interest rates go up, then the cost of borrowing goes up, thereby affecting your monthly payments to your loans. Let's look at mortgage rates, for instance. How do interest rates affect mortgage rates? As you now know, interest rates are the cost of borrowing money. Interest rates on mortgages are typically expressed as an annual percentage of the loan amount, which is called APR or annual percentage rate. Interest rates affect mortgages because they determine how much you pay to the lender. So the higher the interest rates, the higher your monthly mortgage payments are going to be. Next, we're going to be looking at what are the effects of the Fed rate hike on the stock market. The stock market is always impacted by interest rates and the Fed's monetary policies. And this is tied to the fact that indexes, for instance, are a good indicator of how well the market is doing, which is a good indicator of how well the economy is doing. When there are good economic times, people feel very confident and they start to invest in stocks. However, when there are bad economic times, people don't invest so much because they're not sure if it's a good time to do so. Tying this back to the Fed interest rate hikes, when this happens, it makes it more expensive for some companies to borrow money. And as a result, they might not be able to afford to borrow money and they will be forced to withdraw from the market. This in turn has a negative effect on the market simply because most individuals don't have enough stocks as much as these companies. And as a result, they wouldn't be able to sell the stocks at a higher price. It also comes with a few opportunities for long-term investors like you and I. So let me explain why I said that. We understand now, for a portion at least, while the Fed rate hike is affecting the stock market and making it take a nosedive. And this is because while your companies that you're invested in are still making money, the cost of borrowing for large institutions or corporations are now higher than they used to be, which might lead to a loss. So take for instance, if you were borrowing at 4% and now you have to borrow at 7%, automatically if your investments cannot beat 7%, let's say for instance before when you were borrowing at 4%, they were like averaging out at 6%, it was a win for you as a corporation. And right now, the cost of borrowing has increased and the stock market is not going to yield as much returns as it did when everything was all good. So from a mathematical perspective, it becomes a loss for a company when the borrowing costs are too high. But as a long-term investor, you know that the Fed rate hikes are not going to last forever. So at some point, the cost of borrowing is going to go down and these companies will be able to have as much money or more money than you and I have to put back in the market, raising the prices up. So right now we're seeing things at a discount because you could buy more quantities than you could before with your regular paychecks. And this in turn would drop the average price of investments in your portfolio, leading to more gains or more returns when the market starts to bounce back in the long term. This is why it is good to understand why you're doing things and why things are happening. Because at this point, you can capitalize on the fact that you can be greedy when others are fearful and make more gains in the long run. With that, I'll leave it here. I hope this video has been helpful. Don't forget to like, share, and subscribe to help grow the channel. Until next time, thanks for watching Hint Hive. I'm Peter, and I'll see you soon.